Technical analysis offers a plethora of tools and indicators to navigate the complexities of financial markets. Among these, the Moving Average Convergence Divergence, or MACD, stands out as a versatile and powerful indicator, particularly for trend-following strategies. This essay will delve into the intricacies of MACD, providing a clear and concise guide on how to leverage its signals for profitable trading. Whether you're a novice trader seeking to grasp the basics, or an experienced investor looking to refine your skills, understanding MACD can significantly enhance your trading arsenal. As we embark on this journey of mastering MACD, we'll explore its underlying principles, interpret its signals, and formulate a robust trading strategy. Our focus will be on trend following, a popular approach that aims to capitalize on sustained price movements in a particular direction. By the end of this essay, you'll have a solid understanding of MACD and how to apply it effectively in your trading endeavors. At its core, MACD is a momentum oscillator that measures the relationship between two moving averages of a security's price. It consists of three components: the MACD line, the signal line, and the histogram. The MACD line is calculated by subtracting the 26-period exponential moving average, or EMA, from the 12-period EMA. The signal line, typically a 9-period EMA of the MACD line, acts as a trigger for trading signals. The histogram, represented by bars above or below the zero line, plots the difference between the MACD line and the signal line. It provides a visual representation of the convergence and divergence between the two moving averages. When the MACD line crosses above the signal line, it generates a bullish signal, suggesting that upward momentum is building. Conversely, a bearish signal occurs when the MACD line crosses below the signal line, indicating potential downward momentum. For our trend-following strategy, we'll utilize two primary indicators: the MACD, set to 12, 26, and 9, and the 200-period exponential moving average, or 200 EMA. The MACD, as discussed earlier, will serve as our primary signal generator, helping us identify potential buy and sell opportunities. The 200 EMA, a widely followed indicator representing the long-term trend, will act as our filter, ensuring we're trading in the direction of the prevailing trend. By combining these two indicators, we aim to increase the probability of success by aligning our trades with the overall market direction. Remember, trading with the trend is like sailing with the wind, making it easier to navigate the market's waters. Now that we've established our indicators, let's delve into the specific entry rules for our strategy. A bullish signal in our MACD-based strategy occurs when the following conditions are met. First, the price is above the 200 EMA. This confirms that the long-term trend is upward, aligning our trade with the prevailing market direction. Second, the MACD line crosses above the signal line. This indicates that short-term momentum is shifting upward and potentially signaling the beginning of an uptrend. When both conditions are met, it presents a favorable opportunity to enter a long position. The idea is to capitalize on the emerging uptrend identified by the MACD crossover, while ensuring our trade is supported by the long-term bullish trend, indicated by the price being above the 200 EMA. Section 5. Identifying bearish signals, capitalizing on downtrends. Conversely, a bearish signal in our strategy presents itself when the following criteria are fulfilled. First, the price is below the 200 EMA. This confirms that the long-term trend is downward, aligning our trade with the prevailing market direction. Second, the MACD line crosses below the signal line. This indicates that short-term momentum is shifting downward and potentially signaling the beginning of a downtrend. When both conditions are met, it suggests a potential opportunity to enter a short position. The goal is to profit from the emerging downtrend identified by the MACD crossover, while ensuring our trade aligns with the long-term bearish trend indicated by the price being below the 200 EMA. Section 6. Exit strategies, knowing when to lock in profits and cut losses. Having defined our entry rules, let's now establish clear exit strategies to manage our trades effectively. Determining when to lock in profits and cut losses is crucial for successful trading. Taking profits. Trailing stop loss. Consider using a trailing stop loss order placed below the 200 EMA or a recent swing low for long positions. For For short positions, place it above the 200 EMA or a recent swing high. Adjust the stop loss as the price moves in your favor. Profit target. Set a profit target based on your risk tolerance and market conditions. A common approach is to aim for a risk-reward ratio of at least 1 to 2, meaning you aim to make twice the amount you're risking on the trade. Cutting losses. Stop loss order. Always use a stop loss order placed below the entry point for long positions and above the entry point for short positions. This limits potential losses if the trade moves against you. Break even. Stop. Once the price moves in your favor, consider moving your stop loss order to your entry point to ensure a break-even trade if the market reverses. Remember, exiting a trade is just as important as entering it. By having well-defined exit strategies, you can manage your risk effectively and protect your trading capital. Section 7. Enhancing your edge tips for maximizing MACD effectiveness. While the MACD is a powerful indicator, combining it with other tools and techniques can further enhance its effectiveness. Here are some additional tips to consider. Relative Strength Index or RSI. Use the RSI indicator to confirm the strength of the trend. Look for bullish divergences where the price makes a lower low but the RSI makes a higher low as potential buy signals. Conversely, bearish divergences where the price makes a higher high but the RSI makes a lower high can signal potential sell opportunities. Avoid sideways markets. MACD tends to generate false signals in sideways or choppy markets. It's best to avoid using this strategy during such periods and wait for a clear trend to emerge. Look for divergence. Pay attention to divergences between the price and the MACD histogram. A bullish divergence occurs when the price makes a lower low, but the histogram makes a higher low, suggesting potential buying pressure. Conversely, a bearish divergence occurs when the price makes a higher high, but the histogram makes a lower high, indicating potential selling pressure. By incorporating these additional tips, you can refine your trading strategy and improve your odds of success in the markets. Section 8. The importance of risk management. Before concluding, it's paramount to emphasize the importance of risk management in trading. No matter how robust a trading strategy is, losses are inevitable. Therefore, it's crucial to manage your risk effectively to protect your trading capital and ensure long-term success. Position sizing. Determine the appropriate position size for each trade based on your risk tolerance and account balance. A common rule of thumb is to risk no more than 1 to 2% of your account on any single trade. Risk-reward ratio. Aim for a favorable risk-reward ratio, where the potential profit is at least twice the amount you're risking on the trade. This helps to offset potential losses and ensure long-term profitability. Emotional control. Trading can be emotionally charged, especially during periods of drawdowns. It's crucial to stay disciplined, stick to your trading plan, and avoid making impulsive decisions based on emotions. By implementing sound risk management practices, you can protect your trading capital, navigate market volatility effectively, and increase your chances of long-term success. Section 9. Conclusion. Mastering MACD for trading success. The MACD indicator, with its ability to identify shifts in momentum and potential trend reversals, is a powerful tool for traders of all levels. By understanding its underlying principles, interpreting its signals effectively, and combining it with other indicators, you can develop a robust trading strategy that aligns with your trading style and risk tolerance. Remember, mastering MACD, like any skill, requires practice, patience, and continuous learning. By studying market trends, analyzing historical data, and refining your approach, you can leverage the power of MACD to navigate the complexities of financial markets and achieve consistent trading success. Always prioritize risk management, stay informed about market conditions, and never stop learning.